This lesson is about realignments in partnership, or we call them changes in partnership. During the lesson, we shall be covering the following areas. Changes in partnership, where we're going to look at a very brief introduction of the changes in partnership. Accounting for goodwill in partnership, where we're going to look at the introduction of goodwill and valuation of goodwill. In valuation, we shall majorly focus on the approaches of valuation of goodwill in partnership. The first one being average profit approach of valuation of goodwill, super profit approach of valuation of goodwill, and lastly, capitalization of profits approach. Right, let us start with an introduction to changes in partnership. Changes or realignments usually occur in partnership, but there are some changes which, when they occur in partnership, then they have major effects on the partnership agreement. Generally, the effect is that the partnership is dissolved and a new partnership is formed through creation or through new partnership agreement. Such changes include the following: change in profit sharing ratio, admission of a new partner, or retirement of an existing partner. Now, when this takes place in a partnership, the partnership is as good as dissolved and again formed, even though this may not happen physically, but it is assumed through creation of a new partnership agreement. After a partner has retired, a partner has joined, or profit sharing ratio has changed. When these major changes takes place, the gains which have been accumulated by existing partners in the business need to be credited to their accounts. This is to accredit them with the benefits which they have helped the business create. They must benefit from the gains that they have created in the business in the past period. Now, there are two methods which are majorly used to account for these accumulated gains. The first method is valuation of goodwill, and the second method is revaluation of assets. In the lesson, we are going to look at the first method, which is valuation of goodwill. And in this method, I would like to start by explaining briefly what goodwill is generally, without a focus in partnership only. Right. Definition of goodwill is that goodwill is an intangible asset and it is linked to an established business. Goodwill is built over time and it is due to favorable business reputation, which one may be for maintaining good relationship with customers or its suppliers, or effective branding. And that makes the business to make or the business is expected to make more profit than similar businesses year after year. That is what goodwill is. A brief summary from the definition that we have looked at is that goodwill is the selling price of a business or going concern minus the fair value of separate net assets. Meaning, if you sell the assets of the business, whatever they will fetch, if you subtract from the selling price of the business or going concern, gives you the goodwill of such business. In essence, goodwill is the selling price of the business or going concern minus net assets, which are assets minus liabilities. Right, take this summary. Take this summary that goodwill is an intangible asset, then it is linked to an established business, and it is due to the reputation of such business, which leads to the business making more profit. We can also say that goodwill is whereby a buyer is willing to pay more for the business as a going concern due to the following factors. The first factor is good location. A business located, let's say a retail store located within the central business district where accessibility is good, the customers is more valuable in terms of goodwill compared to a business located at a remote area. Next is customer relation, good customer relation, the way the business is able to attract customers and maintain them. Good reputation. Good reputation here is to mean a business which is selling its name, a business that you don't have to really advertise too much for it to be able to sell. Well-known products. When the products of the business are well-known or they have been adopted well by the customers, you expect you will not incur a lot of selling costs, and that is goodwill. Experienced and efficient employees in management team. The business is as good as the people who deliver the products and services to the customers of that business. Therefore, a good management team, experienced workers, is part of the factors which contribute to goodwill. Lastly, we have good relationship with suppliers. These are the providers of the services or the goods which the business supplies to its customers. A good relationship is good to maintain discounts, to maintain timely supplies, and even the quality of supplies which are being made. Let us look at the types of goodwill. There are two major types of goodwill. One type is purchased goodwill, and secondly, inherent goodwill. The difference between the two is that purchased goodwill is acquired together with the business. Inherent goodwill is built within the business. Starting with the inherent goodwill is that inherent goodwill is generated internally due to the advantages that we have talked about above there, or the factors which we have talked about above there. So this inherent goodwill is only an estimation, and therefore should not be recorded, brought into the books of the business, and also no accounting entries required for it. That compared to purchased goodwill is that purchased goodwill is in essence the goodwill we talked about majorly when we were defining goodwill. It is the selling price of the business as a going concern minus the fair value of the assets of the business sold separately. This goodwill may be written off immediately against the reserves of the business, may be amortized, or impaired as per the requirements of IFRS. According to IFRS, goodwill should not be amortized, but should be tested for impairment. So it may be tested for impairment according to the requirements of IFRS. Right. I've talked about purchased goodwill. Purchased goodwill is when one buys a business or purchases a business from another business, and goodwill results. It is only this purchased goodwill that is considered as an intangible asset recorded in the books of account. Otherwise, internally generated goodwill is also intangible asset, but not recognized in the books through recording. Goodwill is the amount by which the purchase price exceeds the fair value of the net assets of the business which has been acquired. That is in case of purchased goodwill. Goodwill is not amortized. Like I've said previously, that goodwill is tested annually for impairment. And in this case, an impairment loss is recognized in the statement of profit or loss as an expense. Now, in partnership, goodwill is accounted for due to the following changes. The first change being admission of a new partner, retirement of an existing partner, or change in profit sharing ratio. I introduced this before, that the major changes in partnership are admission of a partner, retirement of a partner, and change in profit sharing ratio. It is these changes that necessitate accounting for goodwill in partnership. Goodwill must be valued at that particular time. Goodwill is then shared among the existing partners in their profit sharing ratio, and then credited to their account. Once it has been shared to them in their profit sharing ratio, it is credited to each and every partner's capital account. Let us now focus on the methods of valuation of goodwill. There are three major methods of valuation of goodwill: average profits method, super profits method, and capitalization of profits method. Let us now focus on the methods of valuation of goodwill. The first method of valuation of goodwill is average profits method, super profits method, and capitalization of profits method. In the average profits method, goodwill is considered to be average profits of the business multiplied by the number of years of purchase. Average profits equal to the total profit of the business within that period of time divided by the number of years involved. And the number of years of purchase means the number of years for which the firm is likely to earn the same amount of profit. Note that in the average profits method, before determining the average profit, the following adjustments need to be made in the profit. One, any abnormal profits should be deducted from the profit of that year. Any abnormal losses should be added back to the profit of that year. And non-operating income, such as income from investment, need to be deducted from the net profit of that year. To illustrate this method, average profits method, this example can be used. The net profit of an enterprise for the last 3 years, the year 2018, 2019, the year 2020, are 24 million shillings, 18 million shillings, and 21 million shillings, respectively. The purchase period is 2 years. Determine the value of goodwill. The solution to this is as follows. Goodwill equal to the average profit, and that is the average profit. It is the total profit divided by the number of years involved. The number of years involved here are 3 years. That we multiply by the number of years of purchase. The number of years of purchase is 2 years. If we do that, we get that goodwill is 42 million. 42 million. The next method is the super profits method. In this method, goodwill is calculated on the basis of super profits. Super profits are the excess of actual profit over the average profit, meaning we get the difference between the actual profit of the business minus the average profits of the business. The difference between actual profit and the average profit of the business. And to determine goodwill according to this method, goodwill is super profits of the business multiplied by the number of years of purchase. And super profit, like I've explained, is actual profits minus normal profit or average profit. And normal profits equal to capital invested times the normal rate of return. Profit generated from the normal rate of return is the normal profit or average profit. And that profit we subtract from the actual profit to get super profit. And that super profit we multiply by the number of years of purchase to determine goodwill. The number of years of purchase is the same as what I explained in the average profit. It is the number of years the firm is expected to make the same profit. To illustrate this method, let us take this example. If the normal rate of return in a particular type of business is 20%, and the investment made in that business is 10 million, then the normal profit should be 2 million. That is 20% of 10 million. In case the investment earned a net profit of more than 2 million, let's say 2.3 million, then the super profit of the business is 300,000. And that is how the super profit is arrived at. After that, let us look at the capitalization method. In this case, we have capitalization of average profits or capitalization of super profits. To begin with, capitalization of average profits. Under this method, we need to determine the average profits. Then after determining average profit, we assess the capital needed for such average profits to be earned. The profit needed to earn such average profits from the normal rate of return. And that is the capital in the capitalization method. Right. Goodwill, in this case, therefore, is equal to the capitalized value minus the net assets of the business. Capitalized value of the business is the average profit divided by the normal rate of return that we have determined in the last slide. The net assets of the business are the total assets of the business minus liabilities in such business. After determining all these variables, then we're going to put them together to determine goodwill as a result of capitalization method, which is capitalized value of the firm minus the net assets of that particular firm. To illustrate this method, let us take this example. Assuming that a firm earns 65,000 as average profit, the usual rate of return is 10%. The net assets of the firm amount to 68,000, and the liabilities are 180,000. The solution to that example, if we want to determine the capitalization of average profits, then the capitalization of average profit or the goodwill in terms of capitalization of average profit equal to the following. Total capitalization value of the firm is the average profit divided by the rate of return, and that is equal to 650,000. Average profit is 65,000. The normal rate of return is 10%, which is 0.1. If we determine the value of the firm using this method, it becomes 650,000. The net assets of the business equal to assets minus liabilities, which is equal to 680,000 minus 180,000. That is equal to 500,000. Goodwill is equal to the capitalization value of the firm minus the net assets of the firm. This therefore equal to 650,000 minus 500,000, and the goodwill of the business using capitalization of average profits method is equal to 150,000 shillings. Then let us look at capitalization of super profits method. In capitalization of super profits, we calculate the super profits, then multiply the super profits calculated. We calculate the super profits and then calculate the capital needed to earn that particular profit based on normal rate of return. Therefore, in this method, goodwill is equal to super profit divided by normal rate of return. To illustrate this method, let us use this example. A firm earns a profit of 900,000 with a capital of 4 million. The normal rate of return in the business is 15%. To determine goodwill using capitalization of super profit methods, the solution will be as follows. Normal profit of the business is the capital 4 million multiplied by 15%, that is equal to 600,000. The super profit of the business is the actual profit of the business, 900,000, minus expected profit of the business or normal profit of the business, 600,000. That is equal to 300,000. That is a super profit. Goodwill therefore becomes the super profit determined divided by the normal rate of return. That will be 300,000 divided by the normal rate of return, which is 15%, and the goodwill becomes 2 million. The goodwill of the business is 2 million shillings.